If I told you that the market is watching you personally and moves against you on purpose, I'd be lying to you. But I understand why it feels that way. You wait for the perfect setup. You do your analysis. You finally click buy. And within seconds, literally seconds, price reverses and goes straight to your stop loss. It happens so often that it can't be coincidence, right? Here's the truth. It's not coincidence, but it's also not personal. You're simply doing exactly what thousands of other retail traders are doing at the exact same moment. And that predictability is what gets you killed. Today, I'm going to show you why this happens and how to finally enter trades that actually work in your favor. Welcome back to the channel. In this video, you'll learn why price seems to reverse the instant you enter and why it's not bad luck. How your emotions are literally signaling the worst possible entry points. Why waiting for confirmation is actually making you late to every move. How smart money uses your predictable behavior as fuel for their trades. Why the time frame you're watching is lying to you. And how to start entering trades where price immediately moves in your favor. By the end, you'll stop feeling like the market is out to get you, because once you understand why this happens, you can finally stop doing it. The first reason price reverses when you enter is that you're entering at the emotional peak of the move. Think about when you actually click the buy button. Be honest with yourself. Is it when you're calm, patient, and following your plan? Or is it when you're excited, anxious, or afraid of missing out? For most traders, the urge to enter gets stronger and stronger as price moves. You're watching. Price is going up. You think, I should wait for a pullback. But price keeps going. No pullback. It just keeps climbing. Now you're getting nervous. You're missing it. Everyone else is making money. The move is leaving without you. Finally, you can't take it anymore. You buy. And that exact moment, that peak of emotional urgency, is precisely when the move is exhausted. Here's what's actually happening. Your emotions are a lagging indicator. When you feel maximum excitement about a trade, it means the move has already happened. The profit has already been made. You're not early, you're last. The smart money that bought way below is now looking for someone to sell to. They need buyers to exit their positions, and right when you click buy with maximum confidence, you're providing that exit liquidity. You're the buyer they've been waiting for. The second you buy, they sell, and price reverses. This is why your best analysis leads to your worst trades. By the time everything looks perfect, by the time you feel certain, the opportunity is gone. The top traders learn to invert this. When they feel desperate to enter, they wait. When they feel scared to enter, they get interested. They've trained themselves to distrust their own excitement. If it feels obvious, it's probably a trap. The second reason you get instantly stopped out is that you confuse confirmation with being late. Every trading educator tells you to wait for confirmation. Don't enter until the breakout confirms. Wait for the candle to close. Make sure the level holds. This sounds smart. It sounds safe. But here's what nobody tells you. By the time you get confirmation, the move is often over. Think about what confirmation actually means. You're waiting for price to prove that it's going in a certain direction. But price proves this by moving, so you're literally waiting for the move to happen before you enter the move. You're not trading the opportunity, you're trading the evidence that the opportunity existed. Let me give you an example. Price is approaching a support level. You want to buy, but you wait for confirmation. You want to see a rejection. Price touches support and bounces. There's your confirmation, so you buy. But where is price now? It's no longer at support. It's already bounced. Your stop loss has to go below support, but your entry is way above it. Your risk is huge. Your reward is small. And if price does what it often does, which is retest the level, you get stopped out right before the real move happens. The traders who actually caught that move bought at support, before the confirmation. They bought when it was scary, when it looked like price might break down. They got the tight stop loss and the big reward. You got the confirmed entry and the instant stop out. Confirmation is not a trading strategy. It's fear disguised as discipline. The top traders anticipate. They enter where they expect something to happen, not where it already happened. This means sometimes they're wrong, but when they're right, they're in early with a great entry. That's the trade-off most traders refuse to accept. The third reason price reverses on your entry is that you're entering exactly where smart money is waiting for you. Think about where you place your entries. Be honest. You buy breakouts above obvious resistance. You buy bounces off obvious support. You put your stop loss just below the recent low or just above the recent high. Now think about this. If you can see these levels, everyone can see them. Millions of retail traders are looking at the same chart, identifying the same levels, entering at the same spots, and placing stops in the same locations. This creates liquidity pools, areas where a massive number of stop losses are clustered together, and smart money needs this liquidity to fill their large orders. They can't just buy 1,000,000 shares at market price. The slippage would be enormous. They need sellers. And the easiest way to find sellers is to trigger stop losses. Stop losses on long positions are sell orders. When they get triggered, they create selling pressure that smart money can buy into. So here's what happens. Price approaches resistance. Retail traders buy the breakout. Their stops are just below. Smart money sells into this retail buying, pushing price back down. Price drops. Stops get hit. Retail sells. Smart money buys these panic sells. Price then goes up for real without you on board. You bought the breakout, got stopped out, and watched price go exactly where you thought it would. This isn't conspiracy theory. This is market mechanics. Large players need liquidity to operate. Retail traders, being predictable, provide that liquidity. The obvious entry is obvious for a reason. It's where retail clusters, and where retail clusters, smart money hunts. The top traders know this. They don't buy breakouts. They buy failed breakdowns. They don't sell breakdowns. They sell failed breakouts. They wait for the liquidity grab, for the stop hunt, and then they enter in the opposite direction. They use retail predictability instead of being victims of it. The fourth reason your entries immediately go against you is that you're fighting the wrong time frame. You're watching the 5-minute chart. You see a beautiful setup, bullish engulfing candle, breaking above a consolidation. Everything looks perfect. You enter long. Then you get destroyed as price falls for the next 3 hours. What happened? You were so focused on the 5-minute chart that you didn't notice the 4-hour chart was in a clear downtrend. Your perfect 5-minute long setup was just a tiny pullback in a much larger move down. You were buying a small ripple against a big wave. The wave won. This is the time frame trap. Lower time frames show you more detail, which feels like more information, but most of that detail is noise. Random fluctuations that mean nothing. The real direction, the real trend, lives on the higher time frames. When you take a trade on the 5-minute chart that contradicts the 4-hour chart, you're fighting momentum, and momentum usually wins. The top traders always start with higher time frames. They determine the overall direction on the daily or 4-hour chart first. Then, and only then, do they drop to lower time frames to find entries. But those entries are always in the direction of the higher time frame. They're not trying to catch every little wiggle. They're trying to ride the big move, using the small time frame only for precision entry, not for direction. If your entry immediately goes against you, zoom out. You might be winning the battle on the 5-minute chart while losing the war on the 4-hour chart. The fifth reason price reverses on your entry is that you don't understand where you are in the market structure. Every move in the market has a beginning, a middle, and an end. Accumulation, markup, distribution, markdown. This is Wyckoff 101. But most traders have no idea where they are in this cycle when they enter. You see price going up. You think, this is a strong trend, I should buy. But what if that upward movement is actually distribution? What if smart money is selling into strength, unloading their positions to eager retail buyers? You're not buying a trend, you're buying the end of a trend. You're the exit liquidity for positions that were built way below. Or you see price dropping hard. You think, this is a breakdown, I should sell. But what if that drop is actually the final capitulation of an accumulation phase? Smart money is grabbing the last bit of liquidity before the markup begins. You're selling right before the reversal. Understanding market structure is about knowing where you are in the story. Are we in the accumulation phase, where smart money is quietly building positions? Are we in markup, where the trend is healthy and you should be riding it? Are we in distribution, where smart money is offloading to retail? Or are we in markdown, where price is falling and you should be out or short? The top traders always ask this question before entering. They look for signs of absorption. They watch volume patterns. They identify whether buying or selling is being absorbed by the other side. They don't just trade patterns, they trade context. A bull flag in an accumulation phase is a great buy. The same bull flag in a distribution phase is a trap. So how do you actually enter trades that work? How do you stop being the liquidity and start trading like the smart money? Here are the rules that changed everything for me. Rule number 1, enter on boredom, not excitement. If a trade feels exciting, if you're desperate to enter, if you're scared of missing out, do not take the trade. The best entries feel boring. They feel uncertain. They feel like maybe nothing will happen. That's when you enter. When it feels obvious and exciting, you're late. Rule number 2, anticipate, don't react. Stop waiting for confirmation. Start anticipating where price will go based on structure, levels, and context. Enter before the move happens, with a tight stop loss, accepting that sometimes you'll be wrong. The math works in your favor when your risk is small and your reward is large. Rule number 3, trade the retest, not the breakout. When price breaks a level, don't chase it. Wait for it to come back and retest the level. Most breakouts fail or at least retest. You'll get a better entry, a tighter stop, and more confidence that the breakout is real. Rule number 4, always check higher time frames. Before any entry, zoom out. What's the 4-hour chart doing? What's the daily chart doing? Only take trades that align with higher time frame direction. Fight no waves bigger than your time frame. Rule number 5, enter where it hurts. The best entries are the ones that feel wrong. Buying when price looks like it's about to crash. Selling when price looks like it's going to the moon. This doesn't mean being contrarian for no reason. It means having the courage to enter at value when everyone else is panicking or euphoric. Rule number 6, know your market structure. Before every trade, ask yourself, where are we? Accumulation? Markup? Distribution? Markdown? If you can't answer this question, you shouldn't be trading. Context is everything. The market is not out to get you personally. It doesn't know you exist, but it is designed to take money from predictable traders and give it to traders who understand market mechanics. For years, you've been predictable. You've entered when it felt right, which was exactly when it was wrong. You've placed stops where everyone places stops. You've bought excitement and sold fear. But now you understand why. And understanding is the first step to change. You don't need a new strategy. You don't need a new indicator. You need to start doing the opposite of what feels natural. Enter when it's boring, wait when it's exciting, buy fear, sell greed, think like the smart money, and you'll stop being their liquidity. If you found this breakdown helpful, hit like, subscribe, and let me know in the comments if this has been happening to you. Tell me your worst instant reversal story. I read every comment. And if you want me to go deeper on any of these concepts, liquidity grabs, market structure, smart money tactics, let me know and I'll make a dedicated video. Thanks for watching, and I'll see you in the next one.